Stocks are on track to post gains for the week, while the US dollar has fallen another 1.2%, extending its slide to a 4-year low. At the same time, precious metal markets have been anything but calm, with volatility running high. So will these trends continue, or are markets set for a calmer week ahead? To break it all down, I'm joined by John Kicklighter, Head of Content at StoneX. Welcome back, John.
Thanks for having me.
It's so nice to see you. I haven't seen you in a while. So looking ahead for the week, what kind of market environment are we actually walking into?
Generally speaking, I think volatility is the order of the day, or the order of the week in this case. We don't have a lot of consistency, and I know that's hard to say because you see something like the S&P 500 as a benchmark for risk, and it's just off record highs. You have volatility measures still fairly low, although they're jittering a bit. And it seems like everything is calm and that you shouldn't necessarily worry about these headline concerns. But I do think that it's a very we'll say risky environment. It's a very charged environment. So it's very likely that a lot of these headlines, which I think we're a very headline oriented kind of market right now, we're not necessarily looking at the economic docket. We're not necessarily looking for individual market moves as the leader. We're watching headlines and seeing how these markets respond to the headlines. So the buildup of U.S. forces near the area of Iran, that is a risk among many headlines that we're just not even paying attention. Speculation on how Warsh, the new proposed Fed chairman, is going to impact monetary policy going forward is definitely going to be something that's going to be dotting headlines, potentially making a holding pattern for, or a foothold for market volatility, or even things that are outlier and have fallen out of favor because of just the packed headlines, like the Japanese potential for intervention. These are all things that could very readily come to the forefront and offer the markets that charge, that drive to actually get some traction in the market. So those are the conditions that we have. And in terms of market approach with this kind of backdrop, I would say you have a high risk of volatility. You haven't much momentum or conviction and trend right now, whether that be a risk on, risk off. And we see a lot of bumps in volatility, but not necessarily consistency of volatility. In that kind of environment, paired with the technical backdrop, I think it's much more a continued breakout risk environment. But I wouldn't necessarily, again, go with breakouts with the expectations of strong follow through. You have to really wait and see that conviction. But I would also look potentially to diversification of risk trend trades. So we've talked about in the past just doing like a S&P versus RSP kind of comparative ratio, or even something along the lines of like the sell US kind of mentality, like the S&P 500 versus rest of world equity indices or your preferred equity indices. That kind of approach, I would stay away from like range trading on very discrete, very clear technical levels for the short-term trader, because those technical boundaries are probably not going to hold up very well with another bout of volatility like we've seen. I wouldn't necessarily do the sell vol kind of trade for the that's favored amongst derivatives traders that are experienced, because even though volatility is picking up a little bit, it is still a very risky discrepancy between risk reward on that kind of approach. And certainly I'd avoid large swings or outright trends, because we just don't have the backdrop for it. We will transition eventually. Time will go through a lot of patterns, but we aren't there yet. I really like to look for conviction. In terms of the markets I'll be watching, I think you have to look for the dollar because a lot of the headline risks, the fundamental risks, the traditional macro risks still align around the dollar. And as you mentioned in the beginning, it is at a meaningful low, and there's a lot of very aggressive talk around its performance going forward. You would be remiss if you did not keep a close tab on gold and silver, which is just exploding in volatility. But I like to say volatility begets volatility. So it's kind of a result of that massive upswing that we had Friday's dramatic decline, and you can continue to see that volatility play out. So it's kind of an inertia thing. I'll watch the traditional equity indices and less the relative consideration, but I also like looking at global indices because it's that comparative perspective of risk in regional consideration.
So, with all of that in mind, then, what themes are really going to drive markets right now? Not the headlines, what themes?
Yeah, so for themes, I think the sell dollar conversation is still a big one. You haven't seen, even though we've seen the dollar drop to a multi-year low, I don't think that I've seen a lot of traction when the headlines that have arisen would indicate that you'd get meaningful traction on that theme. But it's nevertheless something we need to watch very closely because it can be charged by known and unknown considerations, like as I mentioned, Kevin Warsh as the next Fed chairman, but also the government shutdown on and off talk. We have tariffs. The president in the past few weeks has shown he is very prone to returning to tariffs as a threat, especially because the Supreme Court hasn't weighed in. So that is a big one that I'd watch. I'd also watch some outlier considerations. I did mention before Japanese intervention in the FX world. People are watching the dollar yen or yen crosses very closely. The fixed income world, they're watching the JGBs very closely because there is a lot of potential there. And it's one of those abrupt in this market of volatility. It is aligned to that kind of abrupt resurgence of activity. Interspersed with very quiet and unpredictable congestion. So it's aligned to the market conditions as that kind of theme. And I would say the traditional macro elements that we would usually look through in the economic docket are probably going to wane a bit. So focus on growth and GDP because we're coming out of the Q4 GDP updates, which are a little lacking in time sensitivity as it is. Monetary policy will be a little bit more interesting. Because we do have a few major central banks weighing in, although only one is expected to move the policy. And earnings is also kind of a past the crest after this past week with the bulk of the tech earnings and the major cap players.
Okay, thank you for that. And one last thing, since this is a week ahead, what is the top event risk for next week that investors should be watching for? If you can give us a breakdown Monday through Friday, please.
Sure. So on Monday, we have to go back and forth on the headlines of the U.S. government shutdown, of course. At the time of this recording, we haven't resolved that. We have the BOJ summary of opinions. We will be watching very closely. Won't give any indication, almost certainly, of intervention interests, but that monetary policy mixed with the snap election, mixed with the Ministry of Finance-driven intervention pressure, that's a bigger picture consideration. So I'd be watching that. And we will have a run of manufacturing updates, timely ones from the United States, the ISM, Canada, the IV measure, and also China and even Brazil. So some major economic update there on Monday from the factory perspective, which also taps into trade wars and those types of themes. On Tuesday, we have the one major central bank that's expected to move its rates. It's the RBA, which is now expected to hike its rates by 25 basis points, which would be really, aside from the Bank of Japan, the only major central bank that's actually tightening coming out of that dovish policy over the past 12 to 18 months. We want to see how the markets respond to that, and will that return the Australian dollar to a traditional carry trade. Definitely one to watch. Hong Kong, Q4 GDP, it's a good proxy for China, which people take with a grain of salt. And we get in some early U.S. jobs figures, the JOLTS employment figures, which are very indicative and they're interesting in their own right, next to the Nonfarm payrolls even. Wednesday, I would watch UK inflation, Eurozone inflation, the ADP jobs, private payrolls figures. And if you want a really good time-sensitive update on U.S. economic activity, the ISM service factor report. It's not a major market mover, but in terms of it leading the way for growth expectations for the largest economy in the world, it is without doubt the best because it is timely. It is also indicative of over 3/4 of GDP as well as 3/4 of employment in the United States. So it's an important one. And then earnings after hours, Google. So we get another one of the Mag 7 across the wires. Thursday, Japanese FX reserves. Again, you got to watch to see what they're doing, their interactions. It can be difficult to tell when they're intervening on behalf of the yen, but this is kind of an indicative force of how much pressure has been built up over months. The Bank of England and the ECB are due to hold rates But we can see from the policy report from the Bank of England, perhaps some outlook considerations, which will be a little bit more influential. I think the Bank of England over the ECB as being more macro leveraged. And then also the Mexican Central Bank. But I think after hours, Amazon's earnings report is going to be more market moving than perhaps all those major updates from the macro docket, because it is the next in NVIDIA, the last of the Mag 7 to report. It also reflects on consumer appetites as well as tech. And then Friday, Hong Kong FX reserves, Canadian jobs and manufacturing, but really we're watching the non-farm payrolls. And so too will the new Fed Fed chairman in wait, Kevin Warsh, will be watching to see whether the employment trends are going to soften enough that they can justify revamping or reviving their dovish policy press.
Okay, understood. Lots to keep an eye on. John, thank you so much for your time and for all that great insight. And thank you to our viewers for watching. For more financial content, don't forget to like and subscribe to our channel.